Hey guys, welcome back and happy Friday. So today I decided I'm gonna do a weekly update every Friday on the portfolio. I may create videos more often than that. I may not. But at least every Friday I plan to put a video out with my portfolio updates and the top winners and losers in my portfolio, that type of stuff. So I'm gonna do that today. I'm also gonna talk about um, some tweaking I'm doing to my portfolio. I know this is supposed to be a long-term um, thing where I don't change my companies, and but I'm just starting, and I'm really confident with, like I said originally, in about 90% of them. But there are some that, that 10% that I want to play with a little bit, and so at the start here, I am going to be tweaking and selling a couple companies off and replacing them, um, especially when I see much better opportunity. Um, so, long story short, I say that an awful lot. Hope that doesn't annoy you guys. Anyways, so what I've done so far is, where is it? Let me go here. No, no, no. All right. So I want to talk about a couple things I did. So what I did is I looked up these, and I knew they existed, but I needed to do some research on Canadian investments, and tax implications and all that good stuff before I decided. But basically, if you didn't know, Canada's banking system is much more secure, stable, whatever the proper word would be, than the United States. And it has a very long history. There are like five major banks in Canada, and they've all paid dividends consistently for 100 years straight. And that would be these five right here. And I want companies that have paid a dividend consistently for 100 years. Now, mind you, these have not grown that dividend every single year for 100 years, which is what the majority of my portfolio has. They've increased the dividend. Zoop. You can see most of my portfolio, 63 years, 62, 45. I mean, the majority of my portfolio, they've grown they've grown their um, dividend for, a long freaking time. Um, 18 down to 7, blah blah blah. But I mean, the majority of them are like 20 plus. So yeah. Anyways, long story short, now I got a bunch of pretty colors here and rainbow colors, and I'll explain that here in a second. But basically, I wanted to add at least two of the Canadian banks that have been paying for over 100 years, and so of course I'm going to go with the ones with the highest yield. Um, so that's Bank of Nova Scotia, however the hell you say that, and the other one. Anyways, the payout ratios are great. If you didn't know what payout ratio is, it's the amount of money they pay out in a dividend compared to the amount they earn. So, of course, if it's over 100%, then they're paying out more than they earn. So these in the mid range of right around 40s and 50s are awesome. These have not grown the dividend for a long period of time. This is only 1 year and 2 years. But they have paid a dividend for over 100 years. And if you look these up on the dividend history, so we'll say BNS, and we go to our dividend history, you can see that it's pretty stable. So we'll go back, what is this, 2003? All right, we'll go, say 2007, before the big financial drop that we had before. So 37, 42, 47, 45. So even in 2008 and 2009, they didn't drop that much. It went from 49 to 39. All right, that's a big drop, but still, they immediately came back with the next quarter up to 40s. And they've been stable 50s, 50s, 60s, 50s, 60s, there's an 82, but then of course they can't maintain that. They've dropped back down to 65. So it looks like they're putting out a percentage, a pretty good percentage of their profits at all times, no matter what their profits are. And I like that. It's stable, it's good. And the other bank is the exact same way. So anyway, long story short, again, I like repeating that, is I really wanted these two banks. And so I looked up the tax implications in Canada, and basically Canada will automatically take 15% of your dividends for tax before they give it to you. But if it's in an IRA, they waive that. Normally in a taxable account, they'll take their 15% tax, and then on your taxes in the United States, you can deduct the taxes you've already paid to Canada. And that makes up for it. So that way you don't have to pay the taxes on your own, get double taxed. So anyways, I wanted to add these. So the thing is what companies am I going to get rid of to add these? And so I went through my portfolio and I did a lot of soul searching, researching which ones I really didn't want. And I found them to be Douglas Emmett, which was a REIT. It did have a pretty low yield for a REIT, and it's only got 7 years of growth on it. I already got earned dividends on it of 9 cents. I should get those on 10/16, even though I've sold it now. So that should show up. So what I'm going to do here is I'm just going to cut that so that over here on my dividend page, just so I can track that, make sure I get paid that. And we'll just delete that row. There we go. All right. The other one I sold was a railroad, Norfolk Southern Corporation. Now they've been around a long freaking time, but they've not. I don't know Norfolk Southern as well as I know Union Pacific. Union Pacific is the railroad industry in my mind. I know Norfolk Southern's probably been around just long or close to it, but they also had a pretty crappy yield, and they've been growing it for 8 years. It's the same as Union Pacific, and I fear I don't need two railroads in my portfolio. So Norfolk Southern gone. So we're going to delete that. Whoop. Where's delete? There it is. All right, so that's gone. So now that should put us back at an even 100 stocks. Sales 101 because of my title thing. So now we're back there. Now, the two I bought were Bank Nova Scotia and Canadian Imperial Bank. And I'm very happy with those, even though they don't grow theirs. They're stable income, stable dividends for over 100 years. I expect them to continue paying pretty much. Now, the other thing that I've been coming across is there's one more stock that I really, really want. It has an 8% dividend yield, and it's very stable, and it's a REIT. If you didn't know what REIT is, it's a real estate investment trust. Basically, they are required to pay out 90% of their profits to the shareholder, and that way and then the government does not tax them. So you pay taxes on it and they don't. But since it's in an IRA, specifically a Roth, I don't pay any taxes on those. So those are going to be amazing in my Roth. I currently have 8 REITs in my portfolio. But I really want good, which is Gladstone Commercial. Gladstone Commercial. If we come over to Yahoo Finance, go to Profile, you'll see that their REIT, they focus on acquiring, owning, and operating net leased industrial and office properties. So I think industrial and office properties pretty good for real estate. And they've been paying forever, not forever, but a long friggin' time. They pay monthly, 162 monthly cash distributions in a row. They've been doing this since 2003. Now, this is even during the stock market and real estate crash in 2008, 2009. So that's pretty damn good and pretty damn stable. So I really, really want them. Like I said, their dividend yield shows 7.99%. I did figure it out myself with the current price, and it is actually 8.02% right now, right this second. So yeah, 8% yield and very stable. I like it. I like it a lot. So I need to get rid of a stock. And to do that, I soul searched some more. I thought, okay, well, I'll replace a REIT with a REIT. So I have Store Capital Corporation, which is another REIT. I could replace it. It's currently got 4.74 yield, though, which I like. That's pretty decent for a REIT. I mean, it's average. It's much higher than you can get on most of these normal equities. So I was thinking about doing that, and then I was like, okay, well, I've got the majority of my stuff. I don't really want to get rid of a lot more real estate. I could get rid of some utilities because I got 14 of them. I could get rid of industrial because I got 16 of them, or I get rid of consumer staples because I got 18 of them. So of course, the one I really want to get rid of is consumer staples. Although consumer staples is my primary, and I want it to be my primary because people are going to buy those no matter what the economy does. These are, foods and stuff that people need, foods, cleaning supplies, that type of stuff. So that's why they're my majority. But I have plenty of them, and I could go without one more. I could go with 17 instead of 18. Industrials, I got 16. Materials kind of falls into line with that. I could really get rid of one of those without a problem. I did just add an industrial recently, which you'll see in my previous videos. I added Caterpillar. And no, I'm not getting rid of Caterpillar. Anyways, so to find out which one I want, I looked at yields. I looked at the length of time that they've been paying dividends, and just kind of looking at their portfolio and seeing what they actually do, what they're investing in this case, Store. And it really came down to I wanted to keep Store because it has a very, very decent yield. And I like what they invest in. So then I was looking at the industrial and consumer staples options, and General Dynamics and Lockheed Martin kind of go together. Lockheed Martin, I'm definitely not getting rid of. I really like Lockheed Martin. I mean, we're talking missiles and space and military, and they're just doing all kinds of good stuff. Now, General Dynamics does a lot of military stuff too, but their yield is not up to par with Lockheed Martin. Lockheed Martin seems more dynamic to me. Kind of funny, dynamics. So yeah, I was thinking, okay, well, if I get rid of one of those, it'll be General Dynamics. Then in the consumer staples, it was Smuckers that I was really considering. And the only thing that holds me back from Smuckers, it really is that 3.22 yield compared to getting rid of one that only gives a 1.84% yield. This one has grown their dividend for 4 more years than Smuckers, but I have no reason to think Smuckers won't grow theirs for the next 4 years. Excuse me. So, anyways, long story short, yes, I repeated it again. I wonder how many times I say that in a video. You guys should count and point it out. Anyways, I have decided to get rid of General Dynamics. So, let's do that. We're going to log into our M1, and I'll just walk you guys through this in case you guys don't have an account yet and you just want to see how selling a stock in a portfolio and that type of stuff works on here. Do a little two-factor authentication. All right, so what I'll do is this is my portfolio. I'm just going to edit it. And then I'm going to find General Dynamics, which is GD. And that is the one I decided on, right? Yeah, it's got the asterisk. That's what I put there. All right, General Dynamics. We're just going to click it, and we're going to hit remove. Bam. Gone. And then we're going to add good. So we're going to hit add. Add in Gladstone commercial. Add it and add. And we're going to put that at 1%. So our total, yeah, our total comes to 100%. We're 1% on everything. And we're going to save. It's going to pop up with a little warning probably. Or not. Oh, it's because I did it in my pies. Damn it. Did not want to do that. I didn't know I was under my pie and not my portfolio. So we'll go back to our portfolio and do the exact same thing. Edit. Oh, it's already there because I did it in the pie. I guess whether you do it in the pie or over there, either way, it doesn't matter. So go back. So now, as you see right here, it says remove slices. So they'll be sold. So it's going to sell General Dynamics automatically. And goods not going to be listed in here yet. Well, actually, it probably will. But it'll probably be... Where are you? Right there. 0. So tomorrow, it'll automatically sell General Dynamics and buy good. And there we go. And I'm happy with that because what's going to do is going to increase my dividend yield from 3%, my overall average, it's like 3.03 to 3.96, which, yeah, okay. But I mean, I got rid of one that was paying 1.84% yield and added one that's paying 8% yield. I'm very happy with that. So there's that. And that's all I'm going to do on this video because it's already getting long. So I'm going to close this video, and this will be the video about tweaking my portfolio. And then I'll create another video for the weekly updates. All right. Thanks for watching, guys.